Hello, Secure Transaction students. Good to see you again. We are continuing our adventure in secured transactions, and the last assignment we talked about perfection by possession. We're really going to get to, and I'm glad I'm going to be around next week to really work through this with you in person, is perfection through financing statements. That's really 99% of the perfection action when it comes to secured transactions. But there is such a thing as perfection by possession, which we've talked about for those 5 categories of tangible and quasi-tangible goods. And then there's some situations in which you get automatic perfection. And we saw one example of that with respect to taking a security interest in documents in the warehouse receipt, where you get automatic perfection for 20 days, this 20-day grace period, during which you should then assure your continued perfection by taking possession of the document or filing a financing statement. And now we're going to continue on that theme. In our next assignment, we're just doing 2 problems, and I'll talk about one case. Automatic perfection, and those situations in which there is automatic perfection are listed in 9309, so take a look at that. We'll only focus on a couple situations in which you get automatic perfection, and the most important one is in problem 47, where we have a purchase money security interest in consumer goods. And if a company takes, this is going to be a seller usually, but it could be a bank, takes a purchase money security interest in consumer goods, then there's automatic perfection. And the most typical example of that is, say, Best Buy. You go into Best Buy, you buy your desktop computer, spend a few $1,000s, buy it on credit because you don't have the cash on hand. Not a good way to manage your finances, but so typical these days. So you buy it on credit, sign an installment sales agreement, and you grant in that installment sales agreement a security interest in the computer, so that if you default, the Best Buy can seize the computer and then resell it. Okay, well, what we have there is a purchase money security interest in consumer goods. It's consumer goods because you purchase them for personal household use. That's easy. But I want you to be able to recognize purchase money security interest, and we'll talk about purchase money security interests in the context of priority battles later on, but it's important that you understand what this concept is. And it's not a complicated concept, but it's important that you know it so that when you're taking the bar exam, you recognize it immediately and it pops into your mind that that's a purchase money security interest, and these special rules apply to it. What is a purchase money security interest? There are 2 flavors of it, 2 types of purchase money security interests. One is a purchase price security interest, the other is an enabling loan security interest. And you can go and you can look at the definition of purchase money security interest, and you certainly should do that. It's not a easily understandable definition. You'll look at it, and boy, I still read it and reread it, and it certainly could have been drafted in a way that's more easily comprehensible, but it makes sense if you read it and piece it together. It's in 9103. So take a look at 9103, read through it, but let me tell you what a purchase money security interest is. Purchase price security interest is when a seller like Best Buy sells you some goods and takes a security interest in those very goods that it sells you. So it sells you a widescreen TV, sells you a computer, takes a security interest in that computer. That's a purchase money security interest. That company, that seller, has enabled you to buy that computer by selling it to you on credit, and then it takes a security interest in that very thing. And because it enabled the purchase of that very thing, that computer or that widescreen TV, it will be given special privileges in Article 9. It will be able to defeat all other secured creditors, even if that other secured creditor was a bank that took security interest over all inventory long ago and filed a financing statement. It doesn't matter. We will see that the purchase money secured party has super priority and will be able to defeat all competing creditors. So that's one type of purchase money security interest. If you ever see someone selling goods and taking a security interest in those very goods, then you'll have a purchase money security interest. And it doesn't have to be Best Buy, it doesn't have to be a retail store, it could be a manufacturer that that manufactures who knows, plastic injection molding machines and sells them to a factory and takes a security interest in those plastic injection molding machines. If you sell something, take a security interest in those goods, purchase money security interest. The other flavor, the other type of security, purchase money security interest, is called an enabling loan. And that's in 9103 as well. And it's when you're a financier, you're a bank, and you loan money to the debtor with the explicit purpose of having that debtor use the money to buy something, maybe a plastic injection molding machine, give them $20,000 so they can go out and buy that machine, and then the bank takes a security interest in that very machine. Again, it's that bank enabling the purchase of that specific good and taking a security interest in it. It has a purchase money security interest, and it's going to be able to defeat all those other creditors with respect to that specific item. So think about that, understand that. If you have any questions, email me, and we'll talk about it again, and I'll test you guys in class to make sure that you understand this purchase money security interest concept. It will come up again and again. But shoot me an email if you don't understand it. But that's the first concept to get. Now let's look at problem 47. So, Bilko Siding Incorporated put aluminum siding on Mr. and Mrs. Brown's home. They signed a contract on August 4th, giving the company a security interest in all their currently owned consumer goods, plus those acquired in the future. Okay. On September 25, the Browns went to First Financing Company and borrowed $80 for the stated purpose of buying a sewing machine. Okay, and they signed a security agreement with the financing company, granting it a security interest in the machine. So there, you should just recognize right off the bat, this is where I want you guys to be, that that's a purchase money security interest, an enabling loan. The bank loaned them $80 for the express purpose of buying the sewing machine, and then the bank took a security interest in that very sewing machine. Purchase money security interest in that sewing machine. First Finance did not file a financing statement. Okay. The Browns bought the machine on October 11th, and they filed for bankruptcy. This is always the story when you're in secured transactions. There's always a sad ending. They filed for bankruptcy on October 12th. Bilko, First Finance, and their trustee all claimed the machine. The trustee referred to as the bankruptcy trustee, who, as you remember, is put in charge of the bankruptcy to gather up all the collateral, oversee this automatic stay over any actions that are initiated against the collateral. You can't get at the collateral. They gather it up and protect it against any legal action, and then begin the orderly disposition of the collateral and the payment of the various debtors. So that's kind of the role of the trustee in bankruptcy. But of course, First Finance and Bilko, the signing company, they want to get at the collateral they have a security interest in. So we'll see how this plays out. A. Did Bilko's security interest attach to the sewing machine? And the answer to that is no. There's a rule in Article 9. A general rule is that you can create a security interest in any after acquired collateral, any after acquired property. But there's a limitation on that rule when it comes to consumer goods, that you can only attach a security interest to consumer goods that are acquired within 10 days after the giving of value. And here they put aluminum siding on the house in August, and here we acquired the sewing machine in October 11th. Well, there's only 10 days. You know, the security interest is only going to attach to consumer goods acquired within 10 days of the giving of value. Here we have months pass, so it's not going to attach to the sewing machine. And that's to protect consumers, because you can get all kinds of poor people. I mean, these poor people, they need siding on their house, the rain is coming in, they need a new roof, God knows what. They don't have the money, and so they get subjected to this unscrupulous contractors want to take a security interest in all of their consumer goods that are existing or hereafter acquired. We can't allow that to happen. If that were to happen and they couldn't pay for whatever reason because they have medical bills, Bilco's going to come in and confiscate and sell off their dishwasher, their tables, chairs, their beds. The house is going to be stripped clean, and we don't want to give companies that kind of power. I mean, America is capitalistic and pro-creditor generally, but there are limits, and this is one of them. You can only grant a security interest in those consumer goods that are acquired within 10 days of value given, which can still be a huge amount. I mean, they had their bed then, they had their washing machine then, they had their dishwasher or dryer, so you know, it's not that much protection, but there is some limit. And why would Bilco even want a security interest in the sewing machine? This is asked here. I mean, what, a little sewing machine, they're owed thousands of dollars. You know, I guess there is some financial security, but it also has this, as it says here, this in terrorem effect. It compels people to pay if they know that the creditor can come in and sell all of their worldly goods. That has some compulsive effect to urge people to pay off their loans. So there's some benefit there. I mean, no one really wants to go in and repossess a $80 used sewing machine that's really, at the end of the day, only worth 20 bucks. B. Was the loan agreement a purchase money security interest even though First Finance was a lender and not the seller of the machine? Yeah, well, we've talked about that already. I preempted that question. Yeah, it's an enabling loan. Loaned the money for purposes of buying the machine, took a security interest in the machine as a purchase money secured party. C. Would it have been a purchase money security interest if the Browns had used the $80 to pay a liquor bill? A liquor bill? I've never heard of that. A liquor bill? Good God. And had used $80 from their savings account to buy the sewing machine? No. No, it would not have been a purchase money security interest. The money that's loaned for the purpose of buying the sewing machine has to be used for buying that sewing machine. And if it's not, then it destroys the purchase money security interest. You don't get it. It has to be loaned for a particular intent and used for that intent to buy the item that is then used for collateral. Next question, how can finance companies protect themselves from the debtor's misuse of the funds advanced? So you can see how this could be a problem. The bank loans them $80, assuming it's going to have this super priority, powerful purchase money security interest in the sewing machine, and then these borrowers, the Browns, go out and spend the money on liquor. The bank isn't very happy about that. How do you stop someone from misusing the money that's loaned? And this is kind of a silly problem. I mean, I don't know of any bank that's going to lend $80, but it's illustrative. You know, imagine if it was $10,000. You want to buy some factory equipment, and then the company goes off and uses it to make payroll instead of buying the factory equipment. What can the bank do, and what can you do when you are advising the bank to stop this from happening? And what you do is the bank makes out a check of the amount of money and makes it payable to the borrower and to the vendor of the factory equipment or the sewing machine, so that the money can only be cashed and can only be negotiated by if the vendor signs it, and then it can't be misused and it can't be spent somewhere else at the liquor store or wherever they spend it. Okay, so you just make the vendor the co-payee of the check. So, and finally, assuming the $80 was used for the announced purpose, who gets the sewing machine? And you're not given any reference to any UCC provision. This is getting ahead of us a little bit to the priority rules, but I will foreshadow them. That a perfected security interest has priority over a lien creditor. That's the rule. Perfected security interest has priority over the lien creditor, and the trustee in bankruptcy is deemed to be a lien creditor. So if this $80 was used for the sewing machine, it's automatic perfection. There's no need to file a financing statement. Purchase money and consumer goods gets automatic perfection. Look at 9309. Purchase money, security interest, and consumer goods gets automatic perfection. And so the bank, the finance company, first finance company, will be perfected with respect to the sewing machine if the money was actually used to buy it. And therefore the first finance will defeat the lien creditor, the trustee in bankruptcy. And Bilco doesn't have a security interest in it at all because it was acquired more than 10 days after value was given, so they're out of the running entirely. Okay, and then we have this case here, in re short, and it's a complicated case. It's a lengthy case. I hope you enjoyed reading it. I did. And it's about bankruptcy law, and this isn't a bankruptcy course. I recommend you take bankruptcy. It's a terrific recession-proof practice. In fact, it even grows during recessions when companies are going bankrupt. But it's an interesting practice, and actually a quite genteel practice. I've done some bankruptcy work, and there's a very specialized bar, lawyers that do it, and you think it would be quite nasty and litigious, but I found it to actually be quite pleasant. So take that for what it's worth. But in re short, it talks about this situation of a purchase money security interest, which has special status under bankruptcy law. But if it's not a purchase money security interest, it can be voided by the trustee in bankruptcy. So that's the argument that's going on here is there a purchase money security interest? And what makes it tricky is that there was, and the parties agree, there was initially a purchase money security interest, a loan secured by a purchase money security interest, but then that loan was paid off, refinanced by another loan. And when you buy a loan, you buy that loan together with the whole security package, right? If I loan someone $1 million secured on all of their worldly assets, and you bought that loan for me, and maybe you buy it because I want to give you a little bit of a profit, so I'll sell it to you for $900,000. And then you hold the loan and you have to try to collect the whole $1 million and make $100,000 profit. But when you buy that from me for $900,000, you get the loan, you get the payment obligation. My debtor has to pay you now. But you also get the security interest that backed up that loan, so that if my debtor doesn't pay you, you can enforce the security interest. So you get the whole package. And that's what we have here, is we have a loan that's secured by a purchase money security interest, and then is refinanced, that is purchased by someone else who now owns the loan. And the question is whether the security interest that accompanies that loan when you buy it, does it retain its character as purchase money? Or does that purchase money aspect of the security interest disappear? And of course the person that has the loan, that refinanced it, wants it to to continue to be a purchase money security interest, because that is the most powerful security interest. You can defeat all other loan creditors, all other secured parties, even if they filed or perfected first. So you want it to retain its purchase money security interest. And that's the question. What happened here is there were a number of loans. There were multiple loans. Some of them were backed up by purchase money security interest. Others were not. They were just backed up by regular security interest, but not purchase money. And then they were grouped together and refinanced. So you had maybe, I forget what the numbers are, but let's just make it simple. There's a $50,000 loan that was backed up by purchase money, $50,000 that was non-purchase money, and then you sell it off for $90,000. And so now that person that bought it has this loan obligation, able to collect $100,000, the $250,000, and the question is, does that $50,000 that had the purchase money security obligation, does that $100,000 obligation, is it still backed up by $50,000 security obligation that's purchase money, or do you lose that purchase money characterization? That's the question. I guess it's kind of arcane and esoteric, but I hope that makes sense, and we can talk about it again, and shoot me an email if you want to. And you'll read the case, and you'll see that there are basically two different approaches. One is transformation, automatic transformation, or as if you refinance a loan, any purchase money security interest is lost. And it's just everything becomes a regular security interest, and you don't have this special treatment as a purchase money security interest. There's another rule, and this is the majority rule, and the rule that this court takes, which is the dual status rule, which is, yes, the purchase money security interest will continue to the extent of the $50,000, because that's the extent to which there was a purchase money security interest to begin with. And it will continue in those goods that were subject to the purchase money security interest. And the purchase money security interest is always tied to particular goods that were financed or sold on credit. You know, whether it's the widescreen TV or the particular plastic injection molding machine. And the court says, yes, that purchase money security interest in that equipment will continue. And then one further question arises, is as that $100,000 loan, right, that's combined from the two $50,000 loans, as that's paid off by the debtor, do the payments go to the purchase money security interest? A purchase money loan that's secured by the purchase money security interest? Or is the other loan paid off? Because you see you have these two $50,000 loans. How do you allocate the monthly payments that are made if thousands of dollars are paid every month? Do you extinguish the purchase money security interest so that after $50,000 is paid in, you only have, at that point, just a regular secured loan? Or does that $50,000 that was paid into the loan extinguish the regular security interest, and the secured party is left with the better, valuable purchase money security interest? How do you allocate the payments? And that's left to common law and judicial practice. The most typical approach is first in, first out, so that whatever obligation was accrued first, that's where the money is allocated first. So if the loan secured by the purchase money security interest was the first one that was created whenever in the past, then all payments on this combined loan of $100,000 will go to extinguish that $50,000 loan, and when that $50,000 is paid off, then there's no more purchase money security interest. So, purchase money security interest is only effective to enforce the security interest against that collateral, purchase money collateral, to pay off the purchase money loan. You can't use it to pay off other loans. You can only have that super priority to get to particular assets to the extent that there is a loan an obligation that was accrued to purchase those collateral are subject to the purchase money security interest. A lot of technical terms, I know. Just you know, take in the words, think about it. Maybe watch this video again. Let's talk about it again. As I say, we'll talk about purchase money security interest again. Complicated stuff, but we have time to work through it all. Now, let's get to problem 49. We have Octopus National Bank, who sold all the promissory notes it was holding in its vault to Last National Bank. Now we're getting to kind of a peculiar part of Article 9. We have one bank that has promissory notes, these payment obligations that are documented in a simple promise to pay, typically a 1 or 2 page document. So I promise to pay $50,000 at a 10% interest rate by December 31st, 2015. Promissory note, it's clear payment obligation. There may be a few other provisions in it, but it's supposed to be just a very simple, non-controversial promise to pay so that it's easy to enforce. So if someone doesn't pay it, you can just take this one piece of paper, go to a court and slap it down on the bench and say, look, what's to argue about here? It's a promissory note. Promise to pay. Make them pay. So, promissory note, Octopus National Bank sold all of its promissory notes to Last National Bank. Sure, if you have $1 million in promissory notes and you don't want to wait for years to be paid, you just take that bundle and you negotiate it, you sell it to another bank. And they buy it for a discount. So if it's $1 million, they'll pay you $900,000 for it. And then they can wait and collect payment and make a $100,000 profit if everything goes well. Or maybe they'll just make a $50,000, but it'll still be a pretty good return on investment for them. And okay, so Octopus National Bank sold its promissory notes to Last National Bank. Remember that the sale of promissory notes is an Article 9 transaction, with the seller being the debtor and the buyer the secured party. Take a look at 9109A3. Must Last National file a financing statement to make sure it has possession in order to perfect its security interest in the notes? See 93094. The short answer is no. It doesn't have to file a financing statement. But let me talk a little bit about this peculiar twist in Article 9. Why are we talking about sales of instruments? Isn't Article 9 about taking security interests in collateral, security interests in promissory notes? But there's such confusion in the world of finance. Not only the different devices for security interests, pledges, hypothecations, assignments, liens, trust receipts, financing, etc., etc. There was that confusion, which Article 9 cleared up by just creating a single security interest. But there are other transactions that it was never clear whether it was actually a security interest or an actual sale or an assignment. What is an assignment? Is an assignment, it can be assigned for security. Some assignments are really just sales of things, and there was uncertainty about that, and also risks that companies would buy promissory notes or buy accounts receivable, and they would be subject to security interests. And the practice of buying notes and buying accounts receivable is very closely related to giving loans secured on the accounts receivable. I mean, really, there isn't too much of a difference. If you have a bunch of promissory notes, if you have $1 million worth of promissory notes, I could give you $900,000 loan, and you repay me, secured on the promissory notes, or I could just buy them and give you $900,000 and take the promissory notes. There is a difference between the two of them, but they're comparable methods of raising money. Getting a loan or just getting the outright sales price. And so Article 9, the drafters of Article 9 realized that there was this kind of overlap, this confusion, this similarity of transactions. And so what the drafters did was to bring it all under the scope, all under the umbrella of Article 9, and make sales subject to Article 9. And what that does is that it assures that someone that purchases promissory notes, buys them outright, will be assured that they have the best title to those. And they don't have to worry about other creditors claiming that they had a security interest in those promissory notes, because remember, security interests will follow into the hands of the buyer. So if you buy promissory notes, you might always be worried that someone had a security interest in those notes, and even though you bought them, someone else is going to have priority as a secured party and come in and be able to seize them from you and sell them to some other third party. And so if you buy promissory notes, you're going to want to be sure that that's not going to happen, and that you're going to have the best title of those promissory notes, and no other secured party is going to come and seize them when the person that sold them to you goes bankrupt. And Article 9 makes that possible. And you can look at 109A3, and you'll see that the sale of promissory notes is within the scope of Article 9. If you look at the definition of security interest, you'll see that it includes the sale of promissory notes. And this is how it's done. It's kind of a fiction, but it's kind of neat. Is that a priority is given to the buyer of promissory notes, and they'll have the same priority as a secured party who has a security interest in the promissory notes and who is perfected. And this is how it works, is that security interest is defined as the right of someone who purchases promissory notes. So even though it's an ownership interest, it's treated as a security interest. I'm doing the quotes. It's a security interest, even though it's really an ownership interest. You bought them. And you attach your security interest by giving value, the purchase price. Debtor has rights in the collateral, right? The person that sells you the promissory notes. And you authenticate a security agreement. And what is a security agreement but any agreement that gives rise to a security interest? And if security interest includes the sale of notes, then the sale agreement, the purchased agreement allowing you to purchase those notes, is technically a security agreement, even though it's really, between you and me, a sales agreement. So we have attachment, and then what 93094 does is give you automatic perfection. So if you buy promissory notes, you've attached them because you've entered in your sales agreement, which is a security agreement, and then you get automatic perfection. And you will have defeated any other party, whether a secured party or another buyer, who gets a security interest and perfects or files after you. Either gets a security interest and perfects and files after you, or purchases them after you. You'll defeat them. You won't be senior to someone who may have had a security interest before you bought them, right? As you'll see, the priority contests are first to file or perfect. So if there is a bank that had a security interest in the promissory notes, and then you bought them later, you will have bought them subject to that security interest. But you search the financing statements, is what you do, and you find out that no one has a financing statement filed against them. And then you know, okay, that's fine. And there are no other competing creditors now, and I'm going to buy them now, and I'll get automatic perfection, and then anyone who comes along later will be junior to me, and I will win. So there's the sale of promissory notes. There's also the sale of accounts receivable is also subject to Article 9. And we can talk more about that later, but it's the same basic concept. That people buy and sell accounts receivable, and you want to make sure that you have priority over against competing secured parties or subsequent purchasers. And so you can buy them and you can get that priority through Article 9. Okay, that's enough for now. I've gone on for 35 minutes. The next time I see you will be in person. I look forward to it. Okay, ciao from Montreal.